Many thanks for joining us. This is Business Morning. I am Bisi Adebayo. Oil prices are a little steady this morning as investors gauge hopes for a recovery in oil demand against the fears of new lockdowns due to a growing number of coronavirus cases. Prices were offered some support by positive news, though, on the development of vaccines as drug makers and medical institutions rush to find a way to counter the world's worst health crisis in a century. Brent futures were up 0.62% at $43.55 a barrel, while WTI edged up 0.47% to $40.83 per barrel. The closing prices of both Brent and WTI have traded within a $2 channel so far this month. Meanwhile, in the first big energy deal since the coronavirus crushed fuel demand, Chevron said on Monday that it would buy oil and gas producer Noble Energy for about $5 billion in stock. And back home, the central bank in its Monetary Policy Committee meeting held yesterday maintained status quo on monetary policy rates. Highlights of the decision include an unchanged lending rate of 12.5%, a symmetrical corridor of plus 200 to 500 basis points around the MPR, and cash reserve ratio unchanged at 27.5% and liquidity ratio set at 30%. Now, the CBN governor, Mr. Godwin Emefiele, explains that the committee's decision was largely driven by its aim to salvage the economy from the effects of the novel pandemic, which has led to a slowdown in economic activities globally. Let's listen to him.
Given the plethora of monetary and fiscal measures recently deployed to address the impending economic crisis following the COVID-19 outbreak, it will be a relatively cautious option to hold in order to evaluate the effectiveness of these tools at addressing the current challenges, particularly with mounting uncertainties within the domestic economy, as well as the external vulnerabilities. After reviewing the three options, the Monetary Policy Committee noted that the imperative for monetary policy at the May 2020 meeting was to strike a balance between supporting the recovery of output growth and reducing unemployment while maintaining stable prices. The committee noted at this meeting that economic fundamentals have marginally improved by the end of June 2020, following the gradual pickup of economic activities as the positive impacts of the various interventions permeate into the economy. As a result, the committee noted that the earlier downward adjustment of the monetary policy rate by 100 basis points to 12.5% to signal the loosening monetary policy stance is yielding positive impact as credit growth increased significantly in the economy. The committee also noted the positive impact of the various fiscal and monetary interventions on the household and SMEs and manufacturing sector. The committee also noted that increasing NPR at this stage will thus be counterintuitive and will result in upward pressure on market rates and cost of production. In view of the foregoing, the committee decided by a majority vote to retain the monetary policy rate at 12.5% and to hold all other parameters constant. The committee decided by a vote of 8 members to hold and 2 members voted to reduce NPR. All members voted to retain all other policy parameters. In summary, the MPC voted 1, to retain the NPR at 12.5%, 2, to retain the asymmetric corridor of plus 200 and minus 500 basis points around the NPR, 3, retain the CRR at 27.5%, and 4, retain the liquidity ratio at 30%.
And that's where we kick off our conversations this morning. And joining us now to review the CBN MPC decision is a former Deputy Governor of the Central Bank, Dr. Obadiah Milafia. Good morning, Dr. Milafia. Thanks for joining us on the program. Well, tell us, what are your views on the decision of the Central Bank MPC to hold rates yesterday? Was that decision expected?
In a manner of speaking, I would say yes. It was expected. because you would recall that only in their May meeting, after, a long time of keeping the rates, that they had decided to reduce the MPR, monetary policy rate, by 100 basis points to 12.5%. And all other, metrics were kept steady. They wanted to signal that they were very much aware of the huge impacts of the lockdown and, the general slowdown in the global economy. Central bankers by nature are very cautious people. They try not to be emotional and they try not to be stampeded. So in a way, it was to be expected. But if I were a member, and I used to be a member before, but if I were a member of the Monetary Policy Committee, I would have been among the two that voted to further reduce the MPR.
And why is that?
I think that it's slightly way too high. And we need to grow this economy. And the massive slowdown has been very huge. I know that inflation has inched upwards, but at this time, it is largely a factor of seasonality. This is the planting season. And as you know, the food sector accounts for almost 60% of headline inflation in this country. So it is a factor of seasonality more than anything else. So I would have further reduced the MPR by 100 basis points to signal that we want to grow this economy, we want to boost credit, and this is what we would expect, the commercial banks to do to support the government policy and the stimulus package in order to reboot growth and to get the great Nigerian people back to work again. Now, one little thing that is not much known, it's not a little thing, that the CBN keeps in its coffers something like 10 trillion naira of commercial bank money because they've kept the CRR and the liquidity ratios rather high. And we find ourselves in the absurd situation of actually commercial banks turning away depositors. Because once they take more deposits, they're likely to bypass the limit for both the liquidity ratio and the cash reserve ratio. And that is, to me, a very worrying situation because ordinarily, the banks should be in the business of competing for depositors' funds because that is where they get the money to on-lend to customers. So in a situation where we find ourselves, we find commercial banks turning away depositors, to me is a very worrying situation. It's not good for the banking system. It's not good for the economy. Cash just sitting there doing nothing is a gargantuan waste. So we really need to do better. And the second point I'd like to make, really, is that this is a window of opportunity. A lot of our monetary policy has all been calibrated to encourage inward capital flows, not in terms of foreign direct investments, but in terms of money going into the capital markets. God help you if you pitch an entire monetary policy strategy on just trying to encourage external actors to bring in money. It should be far more than that. Our fundamental commitment should be to growing the Nigerian economy, to expanding opportunities, to creating jobs, and to building stability of all the fundamentals of the economy, interest rates, exchange rate, and the rest of it. I think that should be the priority. It requires going back to the drawing board and ask ourselves the fundamental questions of what monetary policy strategy should all be about, whether we have a development strategy and how we can link that development strategy to supporting to monetary policy and getting the two to work together to build a world-class technological industrial economy fit for use in the 21st century.
All right, Dr. Milafia, now let's take a step further into the debt markets now. Of course, open market operations, maturities, and yields on treasury bills are trading well below the MPR. Is there any domestic events that can actually improve yields?
Well, confidence is extremely important. As you know, the people in the capital markets and the stock markets behave, with all respect, a little bit like sheep sometimes. This one is known as the herd instinct. And there's a whole field of finance known as behavioral finance that study the impact of psychology. In this time of lockdown, in this time of a global pandemic, there are panics, there are fears, and so people tend to overreact. My take on this is that a lot depends on policy credibility. When rational actors look around and see that the people making decisions are credible, that they know what they're doing, and they have conviction, and would stand by the policies they are pushing through, and that those policies are in the best interest of the common good of all the people, not the interest of people who have captured the state, not in the interest of vested interest in the commercial banks, not in the vested interest of industrial money bags, but in the interests of ordinary Nigerians, of all the people. And if they know that, and there is credibility, that overreaction will be limited. So we need to work on ourselves on building confidence in having credibility in the policy stances that we take and sending the right signals that we are doing all these policies in the interest of all Nigerians, and that there is a development strategy out there that the monetary policy apparatus and tools are supporting to push forward, to build a sophisticated, diversified industrial technological economy that creates jobs, that expands opportunities, and builds for our happiness and collective welfare.
All right, Dr. Milafia, now let's talk about the exchange rate unification drive of the CBN, of course, which appears to be an ongoing process, even though we didn't hear much about that at the meeting yesterday. Why do you think the CBN actually appeared mute on this yesterday at the meeting?
Well, I wouldn't know, and I'm not in the habit of second-guessing my colleagues who often have to work under difficult conditions and pressure. But I've always been very worried about this, and I think they know my views on this, that keeping multiple rates of exchange is not only bad, it's actually iniquitous. It opens the room for all kinds of rent-seeking behavior. And it is pernicious, it leads to corruption, and it is not good. So you know me, I know you, I give you a different exchange rate. The other person, we don't know them, they don't know us, so we give them at the full rate. That is very bad. We need a unified exchange rate. It sends the clearest signals of transparency, that there is no favoritism, there are no backdoor deals, that sort of thing. So really, this is my view. And I would imagine that they wouldn't want to talk too much on that, because we live in a highly integrated global marketplace. And central bankers, particularly a central bank governor, must choose his words very carefully. In fact, during the times of Alan Greenspan, when he was the chairman of the Federal Reserve of the United States, which is the American Central Bank, he would make sure that his words were very spare. And to the extent that people used to look at the color of his tie and the color of his suit and the color of the bag he was carrying to decide which way the wind was blowing. So we're taking it to extremes. That was taking it to extremes. But it just underlines the point that central bank governors must choose their words very carefully. And those who know the trade will learn to read not only what is being said, but also what is not being said. And I can tell you what is not being said. What is not being said is that, there's a heavy pressure on the exchange rate. And it has been marginally devalued by at least 20%. If you look at what the ongoing rate in the market now. Now, they don't want to rock the boat. So, they don't need to talk about it. But there are pressures. And they shouldn't talk themselves into a devaluation. That would not be right. So I support them in not talking about it. But the pressures are there, and a lot depends on what happens in the next quarter. If there is a resurgence of the pandemic, and if, God forbid, all the actions being taken aren't producing the right results, we might find ourselves in another lockdown. And if there is another lockdown and global oil prices further go down south, we may find ourselves in a position where there is more pressure on the exchange rate. And, I'm not a believer in devaluation myself, but I'm a believer in market-determined principles for the exchange rate. There is only so much you can do to intervene in the forex market because you are dipping into the external reserves to do this. And up to some limit, you wouldn't be able to do it, because if you did that further, it will automatically put a dent on the exchange rate, because rational actors and speculators, we know that they can call you a bluff, knowing that there's only so much money you can use to defend the Naira. But I am for a stable exchange rate regime, and in the understanding that there is no free market, totally 100% free market exchange rate anywhere in the world. That is a fact. People defend the stability of the exchange rate because it is good for the economy, because it stabilizes, financial fundamentals, and it reduces, speculation, and it's good for long-term stability and long-term prosperity. But we have to understand there are a lot of issues that go beyond just finance and economics. They have to do with geopolitics. We have to build a stable and prosperous democracy. We have to ensure law and order and security. In a situation of rising banditry, especially in the Middle Belt, which is the breadbasket of the nation, and in the far north now, all these things, investors and everybody, they're watching. And nobody would want to invest in a jungle, of a lawless and disorderly country. So we must fix those issues because they have an impact on the value of your currency, even on the image of your currency.
All right. We would actually have to wrap up this conversation at this point. We'd like to thank you, former Deputy Governor of the Central Bank, Dr. Obadiah Milafia, for speaking with us this morning on the program.
Thank you.
Our domestic commodities update will be up next when we return in just a moment. Please stay with us. Welcome back. Now, the head of research at the financial derivatives company, Damilola Akibami, joins us now to talk us through today's burning economic issues. Good morning, Damilola. Thanks for coming on the program.
Good morning, BC.
Well, let's begin with you telling us the FDC's opinion about the CBN's decisions yesterday. Did it come to you as a surprise?
No, it actually didn't come as a surprise. We were expecting that the CBN's Monetary Policy Committee would leave rates unchanged, bearing in mind that 2 months ago in May, they reduced the monetary policy rate by 100 basis points to 12.5%. And between May and now, they've also done a couple of things. So, for instance, the shift in the official rate to 318 naira per dollar. So, obviously, we were expecting them to wait and see the impact of recent policy adjustments on markets, on sentiments, on perception. So it didn't come as a surprise to us. And again, looking at the inflation numbers that came out for June, which showed an increase, definitely it would have weighed on their decision. But right now, the MPC is of the opinion that we've done so many things. Let's wait to see what the impact would be, and also what are the inflation expectations going forward. Are we going to continue to see an upward movement, especially now that the Naira has been adjusted? Definitely that will play a significant role on rates, on that decision. So it didn't come as a surprise to us.
Let's talk about FAC allocations now. We saw an increase to 651.18 billion naira shared to the federal, state and local government council as well as other agencies. Now, what drove up the numbers?
Well, the increase was actually due to higher oil prices in the month of June. Bearing in mind that the fact that is being shared in July is based on June's revenue. So we had higher oil prices. The average oil price in June was about $40 compared to $32 in May. So that contributed to the increase. Also, we've seen improved collection of VAT, the value-added tax. We've seen improved collection of import and excise duties. So all this played a role in the increase in FAC allocations. And we expect that in subsequent months, we might see a further increase towards 750 billion naira. And that's because of the Naira adjustments, which actually took place early in the month of July. So definitely, once you adjust your currency downwards, you would get more Naira revenue. And that is favorable for state governments, which depend on the allocations to meet their obligations.
All right, talking about more revenue now, of course, the news of the COVID-19 vaccine is providing some support for the crude oil market as we speak. Yes. Of course, we saw Brent trading at about $43 per barrel this morning. But apart from this, are there other developments that are driving up the markets, the crude oil markets at this time?
Well, in the global oil market, the supply and demand concerns are still what are driving the price direction right now. And like you mentioned, yes, there are news of a possible vaccine being developed by the University of Oxford, and that actually boosted oil prices. But nonetheless, we're still seeing a rising increase in infection cases, especially in cities that had earlier been reporting a decline. So these infection cases are increasing, they're actually dampening thoughts or anticipations of a recovery in energy demand. And this is because if there's a resurgence, or at least we're already even seeing a resurgence in cases, if countries are being forced to impose lockdowns, it would affect economic growth, it would affect the demand for energy and other fuels. So right now, what is driving oil prices? The supply and demand dynamics. We know that OPEC and its allies, they've decided to ease their production cuts by about 2.2 million barrels. So we're going to see as from August, 7.7 million barrels per day. So whatever gains from the production gains that we're going to experience as close as from August, this will be offset by the compensatory cuts that the likes of Iraq, Angola, and Nigeria will be forced to make because they then comply with their cuts. So again, supply and demand dynamics, so depending on which carries a larger weight, we will determine the price of oil going forward.
So what would be your projections for the prices?
We think oil prices are still going to remain around the $43, $45 per barrel because right now the market is still heavily supplied with oil. Definitely the production cuts have had an impact so far, but again, they're reducing these production cuts. And again, we're seeing a pickup in demand in China and other countries. But if, again, those infection cases continue to increase, there's that risk that is still dampening sentiment. So for the second half of 2020, oil prices may hover around the average of $40 to $45 per barrel.
Perhaps another commodity to talk about now is uranium, which has avoided a price rout. Of course, it's up 30% at the half year of 2020. Tell us what's responsible for this.
Well, uranium, unlike other commodities, actually was able to weather the commodity route. And uranium is a unique metal. It's very radioactive. It's used as a fuel for nuclear reactors to generate electricity. It's used as a ballast even for ships. And because of the denseness of that metal, it can also be used as a counterweight for aircraft. It's used by the military for to make nuclear weapons, ammunition. And so it has various uses. But right now, it also, because of the radioactiveness of that metal, if one is exposed to it in large quantities, it's very detrimental to health. It can cause all sorts of cancer. And in Nigeria, we have some states where you can find uranium. So you can find uranium in Kano, you can find it in Cross River, in Akwa Ibom. But it's not yet fully, it's not even, we don't explore it like that in Nigeria compared to South Africa, Niger, and Namibia. So uranium is one of the few commodities that have actually weathered the storm. Obviously, we know gold too because of its safe haven appeal, and it has actually been recording an increase in price.
So why do we need to pay more attention to this particular commodity?
Well, like I mentioned, we have states where you can find uranium, and I've mentioned the uses which uranium can be adapted to for use. But so definitely Nigeria we have it anyway, but do we have the technology to actually explore that? So it's one avenue that the country can look into, and especially even for the military aspect, we know that there's a lot of insecurity that the government is battling with and whatnot. But again, it's caution, it's very radioactive, so it's a kind of metal that has to be treated with extreme care.
Now, another major issue to talk about is the fact that banks are now reducing the amount customers can spend abroad using debit cards, and that's in a bid to limit foreign currency settlement risk. Of course, we know that the country is facing dollar shortages, perhaps because of a fall in oil prices. But tell us, what is the implication of this?
Well, yes, we've seen a lot of banks reduce their their forex limit on their Naira cards. Initially, you could withdraw as much as $3,000 in a month. So it has reduced from $3,000 to $1,000, and some banks even now have reduced further to $500 per month. And this is because of the forex rationing. We talked about oil prices. Forex supply has not improved, and the demand backlog is still there. And bear in mind that right now, even international flights have not resumed. So definitely when that occurs, we're going to see a pickup in demand. So as long as your Forex supply is still being eroded, you're going to feel that pressure. Our reserves are slipping. Right now, it's about 36.1 billion. Very soon, it's going to fall below the 36 threshold to about $35 billion. And the CBN is still intervening in the Forex market. It will get to a point in time that there's no improvement in the fundamentals that the CBN may have to tighten further or come up with other measures just to support the currency. And we're even beginning to see the pressure in the parallel market. The parallel market rate is now trading about $472, $475 per barrel, Naira to a dollar rather. And one would expect that with the unification of rate, there should be a convergence. Yes, in the long term, that would happen, but because, again, our Forex supply, investment flows are down, diaspora remittances are down. So because we're not receiving as much, so that pressure is there. And Forex rationing will continue. We're just hoping that we're not going to have a repeat of what happened in 2016, where there were severe capital controls that were put in place. It's detrimental to the perception of what investors have about the country, and definitely it could affect sentiment about the economy.
I'm sure everyone is hoping that doesn't happen. Now, so talking about the banks now, they're also restructuring 41% of the loans in the country after the CBN placed a moratorium on interest rates and principal debt repayments, of course, to cushion the blow of lower oil prices and the fallout of the coronavirus pandemic. Now, tell us how this will impact their loan books, especially with the total loans that are up 21%.
Yes, so what the CBN has done so far is just basically to try and cushion the impact of the COVID on banks, on economies, and even the impact of lower oil prices. And we know that the CBN has mandated banks to provide moratoriums on interest payments. So just basically to reduce the rate of loan defaults that are going to occur in the financial system. And because if there's an increase in the non-performing loans, definitely it would affect the performance of banks and the financial system as a whole. And we've also seen that the CBN CBN is also going to issue loans to about 36,000 small and medium-scale enterprises. And we know that the SMEs are the engine of growth of any economy. So basically, it's just to try and cushion the impact of the COVID, of the contraction in economic activities on businesses.
Now, where are we in terms of the price movements for domestic commodity prices?
Well, for domestic commodity prices, right now, they're still sticky downwards, and we're yet to enter into the harvest season. But we know that at least towards the end of Q3, we should expect to see food prices ease downwards. And that is good, obviously, because it will impact on food inflation. However, because of the exchange rate adjustment, imported inflation is still going to continue to increase. And because Nigeria has a very high import content, it's still going to play a major role on the direction of commodity prices.
All right, what about power? Are there any developments that we need to note in the power sector?
Well, nothing major is occurring in the power sector. This is rainy season. You would expect to see higher power output, but it's still, so far in July, the average power output has still been ranging between 3,800 megawatts to about 3,920 megawatts, and the constraints are still predominantly gas and grid constraints. We haven't really witnessed any water constraints like that. So right now, we're still seeing average power output over at least, let's just approximately 4,000 megawatts.
All right, I'd like to thank you, Head of Research at the Financial Derivatives Company, Damilola Akibami. Thanks for coming on the program. Welcome back. Now let's get a review of Monday's equities market performance with Eddie Diong Iwan. Good morning, Eddie. So it was another negative outing yesterday at the market.
Good morning, BC. The stock market resumed trading on a negative note, just like you said, following declines in some Tier 1 banking stocks, and that dragged the all-share index marginally by 0.07% to 24,269.58 points. Now, that brought the month-to-date and year-to-date losses to minus 0.9% and minus 9.6% respectively. About 10 billion naira was lost in the market yesterday as the equity cap fell to 12.660 trillion naira. Now, the total volume of trades increased by 90.1% to 305.10 million units, valued at 12.10 billion naira, and all of that changed hands in over 3,200 deals. Sovereign Trust Insurance was the most traded stock by volume at 75.56 million units, while GT Bank was the most traded stock by value at 795.13 million naira. It's a mixed bag on the sectoral chart. As you can see, two counters declined, two rose, and one was unchanged. The banking sector shared 0.45%. Of course, that was due to losses from Access Bank, FBN Holdings, and Zenith Bank. Consumer goods was unchanged as there was no price movement on any of the stocks on that counter. Industrial goods was down 0.01%, and that was due to declines from QTIX. On the flip side, insurance gained 0.36%, while oil and gas rose 0.32%. As you can see, that was due to the gains on Ardova. But let's talk to Charles Fakroga, the chief dealer at CTCO Trust and Investment Company, for more. Good morning, Mr. Fakroga. Thank you for joining us on the program.
Yeah, thank you for having me.
What do you make of the MPC's decision to leave rates unchanged?
Yes, I think at this point in time, the CBN governor and his team, that is the best they can do for now. In terms of uncertainty, they just have to allow all agencies to be the same. But at the same time, they need to transparently implement their various interventions so that the economy will not slip into recession, and investors will be positioned and there will be confidence in the economy.
Yesterday, Fidelity Bank announced a notice of board changes with the entrance of a new MD, and this is just a few weeks after the new chairman was announced. What do you make of the corporate governance restructuring?
Well, I think it's in line with the bank's succession policy, and CBN is closely monitoring everything. So the board changes and the appointment of a new MD clearly shows that the bank has a laid-down procedure for succession. So, and I think it's also in line with their corporate governance structure. I think it's a very good development. However, we'll expect the regulators to keep a close eye on it.
Mr. Fakroga, what's going on with banking stocks? We've seen them leading the declines lately.
Yes, well, you expect that this is not, I mean, for we are not surprised. the banking or the financial service industry is the mainstay of most economies. If the banking sector is not doing well, of course, it will affect other sectors. I think what we are saying is you have more and more patronage of the banking stock. And this frequent buying and selling of equity in a particular sector, prices are bound to go up and come down. However, what we are experiencing, prices are coming down. It shows that investors are really not having so much confidence in some of this banking stuff because they are waiting the Q2 results to get to the market. So investors are just being very cautious. And that's what we are going to advise most investors who are heavy on that sector to be cautious in their investments.
Mr. Fakuga, before I let you go, could you please tell us the outlook for trading today?
The outlook for?
Your outlook for trading today.
Okay, the market has started today. We have started trading. What I see, the market is still going to maintain, investors are going to maintain a very cautionary trade. And traders are going to be very, very careful in terms of their advice and what they tell their customers to do. But at the same time, I will advise these customers to always monitor the market and tell their stockbrokers to buy stocks that meet their own investment objectives. So I see trade going smoothly, a little bit unchanged, but at the same time, we're going to see a little positive in the market today.
Okay, Mr. Fakuga, how is the market reacting to the latest primary market activities? You know, we have TransCore as one of them.
Primary market activities?
Yes.
Yes, you expect that this period, we must give kudos to the Nigerian Stock Exchange. Despite the pandemic, despite the challenges, we see more and more companies coming to list some of their securities in the market. So I think the investors should continue to have confidence, and at the same time, the issuers, the listed companies, to also continue to have confidence in the market. And if they have a good product and they are performing very well, of course, they can list some of their new assets in the market.
All right, Mr. Fakuga, thank you for your input on the program. Charles Fakuga is the chief dealer at City Code Trust and Investment Company. Over to you, BC. All right, Adidia, we'll see what direction the market will face at the end of today. But stick around, we'll still need you to tell us about the debt and the currencies market in just a moment. Of course, we'll also be doing an opening call to London when we return in just a moment. Please stay with us. Let's now go to London, where Juliana Olayinka will be telling us what headlines are driving the markets this morning. Good morning, Juliana. Tell us, how are the markets reacting to the news of the UK government signing deals for 90 million doses of promising coronavirus vaccines that are being developed?
Good morning, Bissy. Well, the FTSE opened in positive territory this morning. It seems as if the cue and the sentiment has been taken from what happened in Europe last night over that mammoth marathon negotiation discussion to secure this EU recovery fund. I think it's worth about 750 billion euros. And even though we are no longer in the EU market, traders still reacted positively to that. So that's exactly what's driving markets this morning. But as you said, some promising news that the government, the British government, have secured 90 million doses of potential coronavirus vaccines. This has come separately from the Oxford development yesterday and is in correlation to several deals and partnerships that the British government has with various organisations, because most countries and labs across the world are all rushing to try and find the first cure for coronavirus. 30 million of these doses are being developed by BioNTech and Pfizer. These are pharmaceutical organisations that have already got to phase 2 of the trial. So the first phase is cleared. They're at phase 2, and apparently the British government are the only government to secure a deal with them. The second deal is an agreement with Valvena, which is a Scottish-based vaccine. So they've got 60 million doses secured, and I believe the government have already put in a further 40 million doses if the vaccine is to be successful. And there's a big if surrounding all of this, because, of course, there isn't a vaccine yet. All there is hopes for a miracle.
Everyone really hopes for a miracle. Well, let's talk about fresh data this morning showing the UK's quarterly borrowing hitting a record high of £127.9 billion between April and June as tackling the coronavirus pandemic took its toll on the public finances. Tell us more about these figures and its implications.
Well, British debt currently stands at about £2 trillion, which is pretty equal to GDP. According to the Chancellor, Rishi Sunak, and Prime Minister Boris Johnson, this isn't the priority. Sorting out employers and making sure businesses can cope post-COVID is their priority. But the thing is, somebody's got to pay for this debt, and there is lots of speculation that come autumn, when the Chancellor does deliver his full budget statement, the one we received a couple of weeks ago wasn't a full budget, it was a mini statement, but the one that comes in autumn, there are strong speculations that there could be a rise in taxes, or there could be a further austerity drive in this country for a very long period of time. I think I spoke to Chimezie or yourself, Bissy, a couple of weeks ago about the capital gains tax, which is under review. Sources close to the Treasury say the review doesn't mean that they are going to pike those taxes up, but who knows? Again, this has got to be paid for. That £130 billion, I believe it is, between April and June is, of course, the most money that has been recorded on record, according to the Office for National Statistics. And that amount in 3 months is more than the government borrowed throughout the whole year of 2019. In June, the government borrowed a record £35.5 billion. That's 5 times the amount that they borrowed this time last year. So they're borrowing lots of money. Of course, they're trying to resolve the issues for COVID-19. But in the society that we live in, Britain, borrowing comes at a cost, and it's the taxpayer that ultimately has to pay for it.
Now, almost 900,000 public sector workers are to get an above-inflation pay rise, including doctors and teachers. Chancellor Rishi Sunak says that he recognizes their vital contribution during the coronavirus pandemic. This perhaps comes as some good news, right?
It's absolutely good news, especially for those 900,000 public sector workers. There are 7 sectors that are going to be receiving this pay rise from about 2% to about 3.1%. The highest pay rise will go to teachers, and they'll be receiving that when they resume duties in September. And really for doctors and teachers, Prime Minister Boris Johnson has emphasised that this money really is to thank them for all of their hard work during the COVID-19 pandemic. So far, 300 NHS workers lost their lives fighting on the front line of this COVID-19 battle. This isn't the first time the government have offered a pay rise to public sector workers. I believe in the past 7 years, this is the 3rd above inflation pay rise that this sector will get. It's great news, but of course, if you're working as a nurse or a doctor, you may still feel as if you're not paid enough. But it actually comes after the independent pay review bodies, who typically every year look at the pay in all sectors, whether public or private, in the economy, and they go to sector leaders. So they've gone to the Treasury, and of course Rishi Sunak agreed. So these between 2% and 3.1% pay rises will start rolling out any time from now.
I'm sure they all can't wait to see that happen. Thank you, Juliana. We'll see you again at 1:30.
Thanks, Bissy.
And it's back to Eddie Dion for a review of the debt and currencies market. Over to you, Eddie.
Thanks, BC. Well, there was some bargain hunting at the NSE OTC market yesterday, which pushed the NSI marginally by 0.03% to 706.64 points and 519.08 billion naira. However, volume and value were lower, as we saw 61,849 units worth 6.76 million naira traded in 16 deals. Now, the fixed income market, the bond market started the week on a relatively bullish note as anticipated coupon payments coupled with FAC allocation disbursement spurred buying interest in the market. Demand was seen across board, although on a less aggressive note due to the MPC meeting yesterday. Yields declined marginally by 3 basis points on the average. In all, we had 25 deals worth 6.77 billion naira. The Treasury bills market continued its relatively quiet note yesterday. Trends, we saw minimal activity across board. We saw little pockets of demand, and on that counter, we saw 16 deals worth 3.5 billion naira yesterday. The OMO market, average yields declined. The average yields were actually unchanged across our market yesterday, with short-term maturities declining. There were 26 deals worth 26.78 billion naira. But let's talk to Ajibola Aero-Phillips, the head FX trading at FBN Quest Merchant Bank. Good morning, Ajibola. Thank you for joining us on the program.
Hi, good morning. Thank you for having me.
The CBN's MPC did not say anything about exchange rate unification yesterday. How concerned are traders about this?
They're a bit concerned, but again, I'm not sure there was a lot of surprises right there. And that's just because, it's usually CBN's modus operandi. Most of the time, they would rather just address it using the administrative measures, like of which you've seen in terms of the ban on importation of maize and opening of foment to as well as FX funding for that, and then things like the rate adjustment and things like that. But it would have been good to hear, what the CBN's plans are. But again, I suspect, or market suspects, that most of it will come through a lot of the administrative measures that CBN typically uses in covering exchange rates.
Since the 20 naira adjustment at the secondary market intervention sales window, how have transactions been in that segment of the market?
There's not so much in terms of changes. The real change will come in the real sector, where the manufacturers and the rest would essentially pass on the cost to consumers. You know that the most liquid market, which is the INE market, has been trading around that levels since March, beginning of the COVID and all of the ripple effects. So market has really been trading around that level in the INE market. But there's slight adjustment for the guys, the manufacturers that are bidding at the retail SMI. So it's some adjustment for them, but no surprises in the sense that what will happen is we'll see the ripple effect in the real sector, essentially.
Thank you for your input on the program, Ajibola. Ajibola Aero-Phillips is the head FX trading at FBN Quest Merchant Bank. Well, that's it on the Market Review, BC. We hope for a profitable trading day.
As always, Eddie, we'll see what happens at the end of the day. And that's where I end today's program. Thank you for watching. I am BC Adebayo. See you later.